We dealt with how to buy a non-current asset with cash. We better also deal with how do we buy a non-current asset when we have a loan. And that's because there's three ways to buy a non-current asset. We can pay cash. We take the money out of our bank account. Easy. We've dealt with that one. And this is the one we're dealing with now. We take out a loan first. So we borrow money from the bank first. The money goes into our bank account, and then we give that money to the seller of the non-current asset. The third way was to buy it on credit, just like we would inventory. However, just note that we don't cover this in our course, so we don't need to know how to process that one. So let's deal with this one. We borrow some money from the bank first, and then we give it to the seller of the non-current asset. So the first thing I guess we do is we go to the bank on 1st of July, and we're going to borrow $20,000 from ANZ Bank to buy a new computer network for our office. We've got a document number here, EFT transfer 91, and we're going to repay that at a rate of $5,000 per year. $20,000 loan, $5,000 per year, so it looks like it's a 4-year loan. So how would this be recorded in the general journal? Well, we've been doing a loan transaction from basically the beginning of the course. So this shouldn't be too difficult. We put in here in our general journal, we need to know rules of debits and credits. First thing is, let's do the bank account. So I've borrowed money, so I have more money in my bank account. So that is an asset and it's going up. So when an asset goes up, that's a debit. However, every debit needs a credit. So what comes attached with that? Well, it's called a loan, and that's a liability. And the amount of my liability is going up. So when a liability goes up, that will be a credit. So I'll do that there. Also, we might get asked for a narration, so we just write something like receipt of loan from ANZ Bank to use to purchase new computer network, EFT 91. And we're done. Now we're going to use that money. We don't have to use all of it. We're just going to use most of it. But we're going to use it to go and buy the new computer network on the 5th of July. And check 101, here's what we're going to buy. We're going to buy $12,000 is the purchase price, plus GST. We're never going to include the GST in the cost of the non-current asset. However, delivery and installation, $3,000 plus GST. The supplier charged the business to have the computer network delivered and installed at its premises. And lastly, we've got a servicing contract, $2,000 plus GST. The business purchased 12 months of servicing from the supplier. In case the network crashes or needs repairs, we can call them and they'll come out and they'll fix the computer network for us. So the question now becomes, what is the cost of this non-current asset? And what we learned in an earlier video is the cost of a non-current asset is all cost incurred in order to bring the non-current asset into a location and condition ready for use. And those costs have got to last for the life of the non-current asset. So when we do depreciation, we'll give this computer network what's called a useful life. How long we think it'll last for. Let's just say, for example, computer network, they usually last a pretty long time. So let's say 10 years, that's going to last. The point is, do we think these costs will last that long? So let's take the purchase price. Well, we're going to ask two questions for all of these. Required to get the asset in a location and condition ready for use? And will it last the life of the asset? And if both of those are true, we're going to say that's part of the cost. So obviously the purchase price, and if the owner gave the business the asset, the fair value, they are always going to be part of the cost. You can't use an asset unless you buy it. Once you pay for it once, that's it. So it lasts for the life. So that's easy. But we also can't use this computer network unless we actually get it delivered to us and installed. That's going to be $3,000. Now, once it's delivered and installed, so that's definitely required to get it in a location and condition ready for use. And once it's installed and delivered, you never need to pay for that again. That's done. So that will last for the life of the non-current asset. So I'm going to say that is part of its cost. The servicing contract. Can you use the computer network without paying for this servicing? You probably can. Not smart. So that one's sort of, I don't know. You could argue either way. However, that is not going to last for the life of the non-current asset. This is only for 12 months. This computer network is going to last a lot longer than that. So we're probably going to have to pay this every year. So that servicing contract, it's not going to last for the life of the computer network. We're going to have to put it here and say that is not part of the cost of the non-current asset. So to answer that question, what's the cost of this non-current asset? Well, we've got the $12,000 purchase price here. We've got the $3,000 delivery and installation. So that is a total of $15,000. So we have our answer. How would we record that? Well, here's what we did. We just said these are part of the costs here. Well, we would record this in our general journal, and we would need our rules of debits and credits. So the first thing is we're going to have a new asset called computer network. So that's like, so we said here, there's no asset going to be called delivery, sorry, there's no ledger going to be called delivery and installation, because that kind of attaches itself to the computer. So these two ledgers here, purchase price and delivery, that's $15,000. That is going to be the value of my computer network. That is an asset, and that value is going up. So the rules of debits and credits say when an asset goes up, that's a debit. So we do that there. The servicing contract was not part of the computer network, so it's got to be called something else. What would it be? Well, because it's been prepaid for 12 months, I'm going to say that is a prepaid expense, which we have learned earlier in the course is actually an asset. So prepaid servicing expense. And that asset is going up. And when an asset goes up, we're going to do a debit there. We're also going to be charged GST on all this, and we learned earlier that GST is never part of the cost of the asset. It's a separate thing. When you pay GST, you are decreasing a liability, not increasing an asset. So what are we doing? We're decreasing a liability, and the rules say when a liability goes down, that should be a debit. So if you figure out 10% of all these numbers, it comes to 1,700. And lastly, how are we paying for this? Well, we're taking it out of our bank account. We've got a loan. The loan went into our bank, and now we're taking the money out of the bank. So that is an asset going down. And when an asset goes down, that's a credit. And that will be the total of those numbers there. Maybe we get asked for a narration, so we'd write something like cash purchase of computer network and prepayment of 1 year of servicing, and we've got the document number in there. So the last thing we need to do is, well, what would this look like in the balance sheet and the cash flow statement? And here's all the entries we just did. I've just got them all in one place here. Let's start with the balance sheet. Working our way through this, what have we got? Well, under current assets, we will have a current asset called prepaid servicing. So that's actually a prepaid expense, and we learned earlier in the course, that is actually a current asset. I'm going to use that up in the next 12 months. Now, under non-current assets, I will have the computer network here. I got an asset there, $15,000. So that is an asset called computer network. However, I've got this loan though, this loan for $20,000, and it was a $20,000 loan repayable at $5,000 per year. So I better put $5,000 as a current liability, and then I better put the rest as a non-current liability. So 5 and 15 is 20. That accounts for all of that loan. What about in the cash flow statement? Well, let's start with operating activities. I have prepaid an expense. That is an operating activity. It wouldn't fit under the definition of investing because it's not a non-current asset. It's a current asset. It says it here. It's in the current asset section, so that will go into operating. I've also paid GST. When I pay GST, that is an outflow in my operating activity section. However, what have I bought? I bought a brand new non-current asset called computer network for $15,000, so that better go under investing activities, and we'll write purchase of computer network, outflow of $15,000. And we just got one last thing. Before we could buy all of these things, we had to go to the bank and get a loan. So that was that first thing here for $20,000. Now, when we go and get a loan, that will go under financing activities. We'd write loan from ANZ Bank, and it would actually be an inflow of $20,000. And there we go. We've put all of the things to do with this transaction in our balance sheet and our cash flow statement.